Corporate finance practice problem using Onenote. Common stock price calculation with the assumption of stable growth. Get ready, it's time to take your chance with corporate finance. Here we are in Onenote. If you have access to Onenote and would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side in the practice problems down in the 1038 common stock price calculate stable growth tab. Also note that if using Onenote, take a look at the immersive reader. Many of the presentations up top will be down here as well. In the text area, same name, same number. These having the transcripts that can be translated into multiple different languages and either listened to or read in those languages, thereby being a good complement to the presentations up top. Closing up the icon, we're going to have our information here that we will then populate into the blue area on down below. We are looking at the common stock this time as opposed to the preferred stock, noting that when we're thinking about these types of problems with the common stocks, such as the price and the yield and whatnot, we have a couple things that are in consideration. And that's going to be not just simply the dividend, which would represent a return on the investment typically to someone investing in stocks, but also the growth in stock and basically variance that could happen with regards to dividends and the stocks as well. So that's a bit more complicated than, say, generally the preferred stocks that we took a look at last time. So we'll make some basic assumptions as we go forward to make our decisions on. We have the annual cash dividend here is going to be assumed to be 5.8. paid at year end, so at the end of the year, stable growth. So unlike the last practice problem where we said they're not growing, they're not going down, everything's basically stable, imagining in the prior problem a stock that basically is possibly a matured stock. They have the years that are the dividends staying stable and the company revenue and whatnot basically staying stable here. This time we're saying stable, but stable growth, that growth at the 8%. So we're expecting then, projecting out growth to be stable, growing this time 8%. Required rate of return for common stockholders. So this would be basically determined by the market. The rate of return that is required is going to be that 16%. Given this information, how could we calculate then the price? So we're going to take the annual cash dividend. That's going to be the 5.8. And then we're going to be taking the required rate of return, which would be the 16%, what the market wants from the stock. Note that when we're considering that 16%, there's a couple things that are involved here. One, the dividends, and two, the basically increase in the valuation of the stock. So if we're saying that the stock is growing at 8%, then we're going to take that 16% and we're going to decrease the 8% and say that part of that 16% is then covered by that 8% growth that is happening in terms of the stock growth, which of course if the stock grows, then you would assume the value of the shares would grow in kind. 16 minus the 8% would then be 8% remaining. And then we're going to be comparing the 5.8 to the 8%. So we'll take the trusty calculator out real quick just to do that calculation here. We're going to take the 5.8 divided by the 0.08%, and we're going to get the 7250. So therefore, we're expecting then the price of the stock then to be, based on this calculation, the 7250. So another way you might want to think of it, and it helps to kind of calculate these back and forth a couple different ways in your mind to understand them. So we're looking at 16% return on the investment. The investment then, if we're purchasing the stock, would be the 7250. Of that 16%, we're saying 8% of it is going to be consumed by the fact that we're expecting growth of the 8%, which leaves us 8% left, which needs to be covered, we would think, by the dividend here. So the 72.5 then times that 8%, 0.08 is the dividend, of course, of the 5.8. So let's do this a couple more times just with some different scenarios on it. Now we've got the annual cash dividend 8.10 paid at the end of the year. So our assumption is at the end of the year here. Stable growth rate is going to be 6% this time. Required rate of return for the common stockholders is going to be the 18%. So the price calculation, we're then going to take the annual cash dividend, which is going to be the $8.10. We're looking at the required rate of return, what the market expects, the 18%, comparing that or subtracting out the 6%, which is our estimated growth. That leaves another 12% that needs to be taken care of basically by the dividend. So then if we take the $8.1 dividend divided by the 12%, So the 8.1 divided by the 0.12, we get the 67.5. So in other words, if we put down the 67.5 and expect an 18% return, we're going to say that 6% is there due to the growth of the stock, the rest then covered by the dividend, which is the remaining 12%, the 67.5 times the remaining 12%, giving us the $8.10 back up to the dividend. Let's do it again. We got the annual cash dividend 7.2 paid at the end of the year, stable growth at the 8%. Required rate of return for the common stockholders now 23, so expected return 23. We have the dividend this time, the 7.2. Required rate of return is 23%. Once again, we're assuming that of that, 8% will be the stable growth, leaving the difference 23 minus 8 or 15. And then if we take then the 7.2 on the dividend divided by the 0.15, we get the $48. So once again, if we put 48 down, we're requiring 23% as the rate of return, 8% of it consumed by the fact that we think it's going to be increasing in value, which leaves us with another 15% that needs to be covered by the dividend. So if we multiply this times the 0.15, we get to the 7.2. Let's do it again. Now we've got the cash dividend 7.2, the stable growth at 9%, required rate of return this time being 20%. 7.2, required rate of return 20. It's going to grow. We're estimating growth at the 9%. Therefore, we need another 11% covered by the dividend. So if we take the dividend of 7.2 divided by the 0.11 or 11%, we get about 65.45. Let's do it one more time. We've got then the cash dividend 8.8, stable growth assumed at 8%, dividend at the 20. So we'll then pick this up. This got the 8.8, required rate of return 20. 8% of it being consumed by the growth. Therefore, we need another 12%, and the 12% will be covered by the dividend, 8.8 divided by 0.12, which would be 73.333333, but then you round it to pennies, because typically that cents has 2 pennies, so 73.33.